Everything you're about to hear is for education and entertainment purposes only. Whilst we are licensed, we're not aware of your personal financial circumstances. Any advice is general advice. Equity Mates operates under Australian Financial Services Licence 540697.
When I met you in the summer.
Equity Mates!
I will say this about investing. Everything you do learn is cumulative. What I learned at 20 is useful.
Welcome to the final episode of the Equity Mates Summer Series. We hope you've been enjoying it. And if you've just joined us for the first time, a massive welcome to the community. This is a podcast where we explore everything that is possible in the world of investing. My name is Bryce, and as always, I'm joined by my equity buddy, Ren. How are you going?
I'm very good, Bryce. Very excited for this episode, the final episode of our 12-part summer series, where we've been speaking to some of the best fund managers and financial advisors in Australia and unpacking the lessons they've learnt from their careers and really trying to draw out those actionable insights to help us become better investors and to help make 2025 our best financial year yet.
So a massive thank you to the experts that have joined us over the last 6 weeks. Today, we are closing out with a returning guest, Mark Lamonica. Mark is the Director of Personal Finance at Morningstar Australia. He is also the co-host of Investing Compass, which is a podcast at Morningstar, and writes for retail investors. Now, this is an episode I think that everyone will be able to take serious action from, and one that we left feeling, I guess, quite enthused with aligning investing goals with strategy.
Yeah. Big income investor Mark Lamonica, and that's been a big focus in the Equity Mates community. If you're not part of the Facebook discussion group, head over there. You'll see plenty of questions about investing for income. Mark, in this conversation, hopefully answers some of those questions, but the income investing is really tied to his personal financial goals.
Yeah.
And so it's interesting to see how clear it all is for him and how he invests on the back of it. So I think something that we can all learn from, whatever our goals are, aligning our investment strategy with our goals. We should also say there's an interesting conversation about Australian residential property and why Mark thinks he will never own property.
Yes, well...
A sacrilege in Australia.
Well, that's because his strategy aligns with the way he wants to live his life.
Now, before we speak to Mark, we want to say a massive thank you to Viola Private Wealth for supporting this series. Viola Private Wealth combines decades of experience with a dynamic approach to investment management. Managing over $2.5 billion in assets, they help high net worth individuals and families navigate an ever-evolving financial landscape with confidence. Charlie Viola has been a massive supporter for us here at Equity Mates, and Viola Private Wealth is trusted by a number of members of the Equity Mates community. So if you want to find out more and speak to the team at Viola Private Wealth, head to violaprivatewealth.com.au.
Without further ado, here is our interview with Mark Lamonica. Well, Mark, welcome to Equity Mates.
Thank you. I'm excited to be back in this new studio. So, it's great.
I think the last time we had you was when we were back in WeWork. Is that right?
Yeah. So big change. I did come here once. I came right before your Christmas party.
Several months ago. Expert of the year.
Expert of the year. Yeah.
It was exciting. You guys gave me a couple drinks. So it was a good way to start a Friday.
And your trophy. Do you still have the trophy?
I do. I do. It's sitting right next to my television.
Yeah. Nice.
I don't win a lot of trophies, so there's not a lot of competition there for space. But
that's good. A lot of guests on this series are returning OG Equity Mates. So, yes, welcome back.
Good.
Yes.
Yeah, let's do this.
So, investing is a lifelong journey. You see Warren Buffett talk about the fact that you can always be learning, and no matter how long you've been in markets, it's something that you may never master. So, with that in mind, what are you working on right now?
Yeah, I mean, and I obviously agree with that quote. I can't disagree with Buffett, at least not in the beginning. But, I think it is interesting that there's always new things happening. You're obviously studying companies, there's new industries, there's new technology, there's obviously different environments if we look from a macro perspective. But really the thing that I'm working on, and we talked about Buffett, we'll go to Munger for a second. He had this quote, he's giving this speech to a business school at USC. And so a bunch of kind of aspiring stock pickers. And he had this quote that you need this lattice work of theory. And you need that to interpret all of these different facts and all these different changes. And, I think the thing that's really been interesting to me over probably the last year, 6 months, is really getting into more of the behavioral side of things, why we make certain decisions, what are the things that trip us up, all these biases that we all have and how that impacts our investing. So I think that's what I've been spending a lot of time working on personally, just because I think while I do keep up with markets, keep up with companies, I think, it's that lattice work of theory that I think is interesting for investors to think about how they interpret things.
Is there anything that you've come across throughout that process of understanding that you as an individual investor have identified as a cognitive bias or something that you're actually trying to remove from your investing process?
Yeah, I think it's important that you take your own personality and temperament into the whole the decision-making process about coming up with a philosophy and a theory. And I think that's really important. So I guess I've been trying to reflect on the natural way that I approach markets. And I think we'll talk about this more also, but, I will say I am naturally a contrarian. I think that, I am kind of turned off by hype. And I think I've missed opportunities. If I look back during my investing lifetime, I've missed opportunities before that. And so I think it's just having that view going in there that, my natural reaction to things like AI is stay away from that. And I think it's just trying to have that lens saying, okay, why am I thinking that way? Let's try to just explore the facts, right? We're trying to act rationally as investors. We know it's impossible, but we're trying to. And I think, those biases that I have against hype and speculation probably cause me not to act rationally. So, I think it's more self-reflective.
Challenging.
To master your cognitive biases, have you invested in anything really hype-worthy these days?
All in on NVIDIA.
Guzman, Nvidia, Bitcoin. What are you buying?
I haven't. I will say that. What I've done, and this has been a couple-year journey, I guess, for me to try to do it. I have some names in my portfolio, so whether it's Microsoft, Apple, things that I probably wouldn't have touched 10 years ago. So I think, I think I always had this value bent. I know that is not necessarily a rational way to invest because a high multiple can be justified if the company is going to grow. And I think it's just been trying to get away from that kind of value investing. And I still have this intellectual attachment to it, but I think trying to get away from that and saying, okay, don't get scared off by some high PE. So I think that's an example of things I've been working on.
Now, at Morningstar, you have a wealth of data at your fingertips. Individual stock picker's dream. Every stock analyzed for moats and valuation and the like. So, we want to, I guess, get your sense of where the market is and what's appealing to yourself and to Morningstar investors at the moment. And on the flip side, if there's anything that's ringing alarm bells. But we're generally positive people, so let's start with the positive side of it. What's attractive to you and the team at Morningstar?
Yeah. So, Morningstar in general, it's hard for me to speak for all of Morningstar. We cover 1,600 shares globally. We have an investment management division so we have that equity research side. We've got an investment management division as well that's looking at markets. They take more of an asset allocation approach to things, and they're very valuation focused. But I thought maybe I'd answer from a personal perspective. So this is my kind of view, and something that. And I talked a little bit about it before. Something that's really important is aligning, of course, what you're trying to accomplish with the way that you invest and your investment strategy. So I think to kind of answer both questions about things that maybe aren't that attractive and where I'm seeing opportunities is, you guys know that, of course, we've had this huge rise in passive. And of course, all those flows are going to benefit the biggest companies. And, really the approach that I take, which I can talk more about, is I'm more of a dividend growth investor. I am interested in income. And, one of the problems is, forget valuation levels, but also dividend yields, of course, come down when share prices go up. So, looking at that and looking at this run we've been on, a couple hiccups, but, a very long run we've been on, trying to look at non-large cap shares. So both in Australia and in the US, and trying to find ones that fit what I'm interested in. Because of course, if we have a reversal in markets, we start seeing that passive money flowing out, what's going to happen? Well, disproportionately, those larger companies will come down, and maybe that will make them opportunities that I think are right for me. But right now, I just don't think a lot of them are.
Do you think the passive money would flow out? Isn't that the question that we're all asking? Like with pension funds and super funds and the rise of index investing, it will keep flowing in
theory.
Yeah.
I mean, I think the big thing is, one, if we look at institutional investors, is are they going to change their asset allocation, right? So the money's not going to come out and go into cash, but is this a situation where whatever happens in the world that they start this, fleeing to safety? And so they may still invest passively, but just move it into bond funds. I think the big question is retail investors. And I'm curious, I hope for people that they are not going to sell if the market starts falling. But I don't think we know that. We haven't really seen a big market drop since passive has become so dominant. So I don't know. Yeah. I have no idea. But, from my point of view, regardless of what happens, even if markets keep going up, if I'm really looking for those dividend growth shares, yes, the growth is important, but that yield's important too. So maybe these will always be somewhat undervalued opportunities, if we keep going to passive, looking in that mid-cap space.
Yeah.
Just on that split between income and growth, why, from a personal point of view, are you chasing income? Is it because you're at that point in life where you want to be supplementing work, or is there a goal you're working towards?
For people listening who can't see Mark, he's not that old.
He's
like our age.
Yeah. Everybody on my team at work tells me how old I am. But I'll start with that. Okay, so this is a little bit strange. There is obviously this sort of natural view that you're younger, you chase growth, you hit retirement, all of a sudden you're interested in income. And I can tell the backstory, but I've been an income investor since I was in uni,
Right.
which is very, very strange, I know. So it's kind of a continuation of that strategy. And really, where I am now is, I am using part of the income to pay for things I want to do in life.
Nice.
And so, one of the things that I really like to do is travel. And I have some of that income that I'm spending now and paying for travel. Nice. And it's, I've got this strange system where every 5 years I have another account that kicks in, so I have more money. So yeah, part of it is that. When I was younger, it's just kind of building that passive income stream, but I am trying to spend it now.
Yeah.
So there is a benefit to my life.
If you ever need help spending it, we can help you.
Absolutely.
So, Mark, I think you mentioning yourself at uni there is a good segue to where we want to go with some of these conversations over this series, which is how investors started out. So take us back to Mark Lamonica when he first discovers this concept of investing. What were you thinking then? What was your introduction to investing, and how did you get started?
Yeah, so I think there's kind of two different times. When I was young, I was fortunate enough that for Christmas and for birthdays, I would get a small amount of shares from my parents. And, I'm 7, 8, 9 years old. I certainly don't know what's going on. And, I think that the good thing about that was, how do you explain investing to a kid? And ultimately, the way you explain it generally is okay, well, you own part of a company. And if the company does well, you do well. And I think that people basically then spend their lives basically trying to forget that. So it's a good foundation. And that's not obviously the only thing about investing. It's not the only secret to investing, but it's a good foundation. And then when I got into uni, it was, and once again, show how old I am, it was during the dot-com bubble. And so many people, and you can tell from my accent, I was in the US at the time. And so many people, I opened up this online trading account, which was kind of new and exciting at the time. And I did what everyone else did. I'd go onto these message boards and I'd buy all this stuff that I didn't understand, companies I didn't understand, that everybody loved, and they kept going up. And yeah, that was great until obviously in my last year in uni, the whole thing fell apart. Yeah. And really, I think more than anything else, there was so much hype in the market. It all was just proven to be BS at the end of the day. And I was looking for something tangible. And to me, like, a dividend is tangible. A company makes money, they give me part of it. And, kind of in that tech wreckage, that's the approach I started taking. And, things have evolved over time, but that's really when I started. And I think that was kind of my lesson. And talking about some of the biases I have, like a lot of that reluctance to get involved in hype and speculation comes from that point.
Yeah, I was just going to say, it feels like from the comments you made earlier around wanting to avoid hype and contrarian, feels like it's been formed from that last year in uni of potentially just being burnt in the .com crash. Is there anything else that you've really taken from that time that you still kind of hold on to today?
This has developed over time. I probably couldn't have told you this at the time, but I think that there are lots of different ways. And one of the things I learned in my job and talking to investors, there's lots of different ways to be a successful investor. We get pitched often by the industry that there's one way. You have to be a value investor, a growth investor. There's lots of different ways. And I think that, ultimately, what works in investing is consistency and patience. And the only way you're going to be consistent and patient is if you have that intellectual attachment to the approach you're taking. And I hear from all these investors taking different approaches. I would never tell, well, in some cases, but I never tell people they're wrong. I think there's behavior that's wrong, but there's no approach that's wrong. And that's just the one that resonates with me.
Mark, we're just going to pause very quickly to say a big thank you to Viola Private Wealth for their support over the last 12 episodes. In a changing economy, adaptability and insight is essential, and Viola Private Wealth offer fresh perspectives and bespoke strategies to help grow and protect wealth, ensuring security and peace of mind in uncertain times. So for more information, head to violaprivatewealth.com.au.
So moving on to today, there's lots of different ways to make money, and you've kind of illustrated your philosophy around focusing on dividends because they're tangible and all of that. But I guess, do you have an overarching investment philosophy, not in terms of what you want to get out of it, which is growth and dividends, but in terms of what you're looking for on the investment side?
Yeah, I mean, I think one way to answer this is just looking at sort of my life philosophy around money and, trying to form that attachment to everything. And, I think, I don't know, have you guys seen Fight Club?
Yeah.
Yes.
Yeah.
Okay. So there's this line in there, and I'm going to probably butcher the exact quote, but it's basically this line around, the things you own end up owning you. It wasn't the movie that really triggered this, but, a brief sort of tangent that I grew up in this town outside of New York called Greenwich, Connecticut. There's a bunch of hedge funds in Greenwich now. It's a wealthy town. A lot of people work in New York, work in finance. And I was starting out my career and I had meetings in New York. I lived in Boston. I remember I was standing on the train platform waiting to go in. So it's freezing cold. It's the middle of winter. And I'm looking around and, you stand out in the freezing cold. The train comes. Everybody rushes in. There are no seats. A lot of people have to stand. I was just thinking, these are all the people that made it. Right? Like in any conventional sense, these people made it. They had high paying jobs. They had big, expensive houses, expensive cars. But this is what they were going through to actually support all of that, all this stuff they acquired. And I think, my life philosophy was just, I don't want any of that stuff. So, I'm 45. I rent a small apartment. I don't own a car. I wanted my investments. I want my salary, number one, to go to pay for things I enjoy. And it's nothing against people that want a house and want a car and everything else. But what I enjoy, as I said, I enjoy traveling. I enjoy going out to eat. I enjoy experiences. And so I wanted to shape my life around that. And I want to shape my portfolio around that. And so if I look at, hopefully I'll be alive for a while longer, despite what my team says about me. If you look at that, what does that translate into? It translates into dividend growth, right? I want that passive income, some of which I'm spending spending, I want that to grow faster than inflation so I can buy more stuff in the future. And I think that is how I view investments. And, it's certainly not this philosophy that just buy the highest yield. Like, I think that's a terrible way to invest. It's finding those companies and finding companies that have moats, that are going to have income growth, because, you need that to support dividends.
Yeah, I love that philosophy. I love, first of all, how you have such a clear life philosophy and then your portfolio reflects that. I think a lot of people just kind of chase the highest number without thinking about like what they actually want out of it. I also think it's interesting that, like the FIRE movement gets a lot of attention and for a lot of good reasons. It encourages people to have a goal and invest towards that goal. But it is really about like delaying your gratification now so you can have it later in life. But your philosophy is different to that. It's you want the growth and you want the dividends, but you want to enjoy it now rather than later.
Yeah, absolutely. And I think I do enjoy the intellectual challenge of working. I'm not, when I was younger, I thought I want out at 50, but it's more about trying to find something that you're interested in. So I'm not looking to hit a number and quit my job and I don't know what, sit on my couch all day. I want to enjoy life and hopefully scale back work as I get older. And I think that's my concern with the FIRE movement. Like, as you said, there's a lot of things I like about it, but it's kind of like, okay, I will live this very frugal lifestyle. Then I'll stop work and continue to live this frugal lifestyle. And I don't want to live a frugal lifestyle. So that's kind of my problem with it.
Yeah.
Now, I want to touch on the property piece, but sticking with the dividends, what are some examples in your portfolio of stocks that are giving you good yields? And perhaps for those in our community, and there are a lot of them who are now looking at dividends and seeing all these high yield ETFs that are now coming to market and a lot of the active managed ETFs. What's your view on actually the best way to build a portfolio that has yield?
Yeah. So maybe I'll touch on the ETF thing first. I do own VHY, so Vanguard High Dividend. I do own that. One of the problems, and I think you need a portfolio that does different things. You need some high yields, you need more growth. One of the problems of dividend ETFs is that if you look at how they're constructed, so there is obviously a set of rules. Those rules can look at backward yields. They can look at estimated forward yields, like at Morningstar. And personally, we like those forward yields to try to avoid the traps. But either way, what they're doing is they are taking a subset of an index, they're including those shares in it, and they're periodically rebalancing them. I think the Vanguard ETF I reference, I think it's every 6 months. The problem is it's hard to get growth out of that. So it's always going to have a high yield, but really the only way that income grows is if the market goes down and the yields are actually higher. So I don't think it's a great way to grow dividends. One ETF that I've been personally buying, so this is not a Morningstar recommendation, I've been personally buying is that Van Eck product that's the equal weighted. So what is it? MVW, I believe is the ticker symbol. Because, I look at the Aussie market, I look at some of the larger shares. So whether it's the banks, whether it's the miners, I don't think they have great growth prospects in general. So I don't think they're going to have great dividend growth prospects. And, I think, okay, well, if I can get more exposure to, once again, kind of that mid-cap space a little bit, I think that there's better prospects for growth.
Yeah, right.
I personally like shares better, individual shares, if we're looking at that. And, just to mention something I've been buying lately is a company called American Tower. So I've wanted to own this thing for like a decade. And, they basically, at the end of the day, they own mobile phone towers, and then a mobile phone company will put their equipment on it. And you're obviously having all these positive trends that data use is expanding everywhere, particularly if you look at some of the third world countries where they have big operations. There is no other option, right? Like everything is mobile data, and as more people move up into sort of a middle class lifestyle, what is the number one thing they're getting? What's the thing they would never give up is a smartphone. And so you're seeing all this data increase. And it's a company I like. They also own a data center business, which we've obviously seen in Australia, how much people like that right now. I think it's interesting. Companies had this long run of dividend growth, like double-digit growth. So the yield's not that high, but yeah, that's something I've been buying and something I'm interested in.
Interesting.
Nice. Now, Bryce said he was interested in property. So
Yeah, well, I just want to, I guess, understand, is it a strategic asset allocation that you're renting, and is that framed around your lifestyle as well?
Yeah, no, people obviously think I'm crazy with this whole thing. I wrote this article, and I will say at the time somebody else put a title on it, but it was "Why I Will Rent for Life."
Okay,
that's good content.
Yeah.
It got all this attention. Like, they put me in the AFR for
Nice.
it.
Oh, wow,
Somebody
okay.
came and took some picture of me, like this idiot that is not going to buy a place. I think it kind of gets back to one of the problems with housing is that, of course, there's these huge cash flows that have to go into it. So not just mortgages, but also just the upkeep and maintenance. And, the low end of the estimates is like 1% of the purchase price. And so I don't think that's that attractive given kind of the life I want to live. And the other problem is, if I want to use my financial assets to generate income for my life, locking a bunch of them up in a house isn't a great thing, I think, in my worldview. And it's nothing against people that buy houses.
Yeah.
And it's really thinking about like what matters. Is that the way, if I'm totally focused on my net worth, is that the way to get rich? Yeah, probably, right? Because it's this huge leveraged bet on property. I don't use any leverage personally in my portfolio. I think I've heard you guys do. But I don't personally do that. So yeah, leverage works really well when things go up in price, and there's nothing that indicates Aussie property is going to crash anytime soon. I do own a couple investment properties in the U.S. Reason they're in the U.S. is, one, they're a lot cheaper. Two, like, the yield that you get. Yeah, you get a 30-year fixed rate mortgage, which I really like. And the yield is the rental yield you're getting on it, like at purchase, is huge.
Yeah.
And so it, once again, kind of fits that philosophy of cash flows.
Yeah.
Nice. Yeah.
I just love what you just said it as an offhand comment there, but like you're not interested in your net worth. It's just all about like the passive income you can generate.
Yeah. And like, listen, everybody wants to have more money rather than less money.
Yeah.
But I think it's about thinking like, how does that wealth that you can accumulate, how does it benefit your life? And another zero on your net worth, how big of a difference is that going to make?
Yeah.
So I'm just sort of focused on how to improve my life.
Yeah.
Nice.
So with that goal in mind, we've been asking this question in every interview this series is, if you had to set up a retail investor's portfolio today for the next 30 years, how would you invest it? And I guess maybe let's give it a little tweak based on your philosophy, which is a retail investor's portfolio for the next 30 years with a focus on generating passive income. How would you invest it? Now, if you want to tell us specific names, you can, or if you just want to tell us generally like your principles of portfolio construction and how you would approach it. How would you think about it?
It's a really good question. It's a hard question. So 30 years is 30 years is a long time. I mean, I think ultimately, and I do get blowback from people around this focus on income. I think they're interpreting it wrong, perhaps. But really, at the end of the day, if you want to grow passive income, you need companies that can grow for 30 years in your portfolio. Now, there are different ways to go about that. You can have a company in a very mature industry where there isn't a lot of industry growth, and they can still grow if they have pricing power. But, I think it's thinking, and I like the 30-year thing. Everything I buy, Buffett's Maxim, obviously, which he doesn't follow, right? Like, there is a lot of turnover in those portfolios. He keeps pointing at Coke, which he bought a long time ago, but there is a lot of turnover.
For people who aren't familiar with the maxim that we're talking about, it's you have to be happy to own something even if the stock market shut for 10 years and you couldn't sell it. Yeah. That's what you're referring to.
Yeah, exactly. And as I said, it's interesting, there is a lot of turnover, but, I think it's like, okay, think of all the factors that over the next 30 years can hopefully have this company that you, I hope, could own for all 30 years, think about all those factors that are going to impact it. So really it's, okay, keeping competitors at bay. So focusing on the business, the competitive dynamic, and hopefully a moat, a sustainable competitive advantage. And that should show up in all the right places, right? You should have pricing power. They should have higher margins. So kind of fundamentally looking at that. I think valuation is important, but over a 30-year time frame, I think you just have to not buy something that's insane. That they can never get that growth. And my focus on yield, and I'll buy very low yielding shares, I think can grow that income a lot. I focus a lot more on yield than I think like pure valuation. So, ultimately it's own great businesses. And I know that that's an easy thing to say. But, we've seen a lot of examples where things with hype were not great businesses, and then things with hype were. So I think it's just thinking about that business, removing that share price and what it's done from your analysis of that company.
What are your thoughts on is it the dividend aristocrats over in the States? There's that group of like 50 odd companies that have like increased dividends every year for 25 years or something.
And then there's the dividend kings, which I think are like 50 years or something.
Are they in your portfolio?
A lot of the names are. That is what I like. I think, one thing is dividends are a little different in the US and Australia. One, obviously the yield is a lot lower. The other thing is just the general attitude of companies is different. Like a US company will try to prevent a dividend cut. Like they will do anything to do that. It's just like this horrible signaling mechanism to the market. So if they cut their dividend, they are in a lot of trouble.
Right.
And, I think kind of those dividend aristocrats, they could be, raising the dividend by a cent a year, but I think they want to stay on that list. Australia is different, right? Because companies generally pick a percentage of earnings. There's more cyclical companies here, so you do see more variation in dividends. I think here I'm trying to look at something that throughout the cycle keeps going higher, knowing that things will drop off, but I certainly like the concept. That's what I'd like to. That's what I'd like to own here.
Yeah. So, Mark, as we close out this interview, we want to, turn to some lessons, both short term and long term, that you can leave the audience with and leave Bryce and I with. So let's start short term. The last 12 months has been interesting. We're looking at it before time of recording. The ASX 200 is up about 20% over the past 12 months. The US market's up, almost 40% over the past 12 months? It's just been wild. What have you learnt in that time about yourself and about markets generally?
I think there is actually a lot of optimism out there. It's hard to see sometimes because there are always, and I think investors that have just gotten started miss out on, there's always things to worry about. I can list 20 things that people are worried about, but overall we have to say people are pretty optimistic, right? And I think optimistic around AI, obviously, that we talked about before. I have a little bit of a different take on like who will benefit from AI, which I think is going to be every company. I think we're all very focused on companies that are creating the technology, but will it actually be differentiated? I don't know, but I think most companies will have access to it. They'll get more efficient. Kind of same thing with the internet. What did the internet benefit? Well, it benefited almost every company. And a lot of those initial names didn't do great that were the providers of the internet. But there's a lot of optimism. And, things are not going to continue this way forever. And so I guess what I just say to investors is start thinking about, going through in your head, what would happen if markets drop 20%? Start visualizing, because that's going to happen in your lifetime. Any investor, unless you're on your deathbed, like that's going to happen. I would just say in this really optimistic, positive time, like enjoy it, but think about, what will happen if markets sell off and what you'll do, and trying not to make those mistakes.
Thinking back to your uni days, Mark, if there's one lesson that you could teach yourself as that young investor, what would it be?
I think it's, we've talked about some of the foundational stuff, aligning what you're trying to achieve and your philosophy and temperament and everything else. I had a lot of bad behavior as an investor. And, even after this .com crash and my kind of switch into, okay, I'll focus more on dividends, like I traded too much. I just turned over my portfolio too much. And I think I had a little bit of money. I was in uni. I wasn't working. There was no money coming in. So every time I came up with this idea, I had to sell something. That was just really, really poor behavior from, I wasn't making any money. So frankly, the tax outcomes were not that bad at the time. But it was just this really poor behavior that held me back. And, I can sit there as a 45-year-old and think, wow, if I would have just bought some solid names, I still own a couple things from that era, but if I would have just bought some solid names, stayed in them, I would be in a much better position today. Like I can't get that time back. So I think it's just focusing on behavior and what are these mistakes that hold us back. Yeah, people always say, it's a cliche, think about your future self. But yeah, I wish I had that opportunity. I wish I could go back and even without knowing where share prices went, just go back and kind of relive a couple of those years and just not waste all this money on transactions and taxes and everything else.
Very relatable.
I know. We think about that, like the big opportunities that just passed us by, all of those big tech companies coming out of 2008.
Yeah, exactly.
Anyway.
Before we all start getting too upset here. We'd be doing this interview on your yacht right now.
I know. Well, no, the flip side is if we nailed investing early, potentially we wouldn't have been doing this podcast because we would have just been making too much money investing. So,
I guess that's a good flip side.
Yeah. But anyway, Mark, the last question that we've been ending all these interviews with, this is your chance to call out some conventional wisdom in the industry that you think is wrong or some things that you often hear, financial media tell everyday investors. Do you think there is something that's out there, some conventional wisdom that is wrong in the finance industry and should be ignored?
I think there's a lot of it.
Okay.
I'll concentrate on one thing, but I think one of the challenges that individuals have is we take our cues from professionals, right? So you think about a typical AFR article. They get some portfolio manager, he or she picks a couple names that they're investing in. You have no context, right? You don't know if they own 500 shares and this makes up a, tiny percentage of their portfolio. You don't know if they sell it a week later. And I think sort of what gets portrayed in the media, sort of the behavior that professionals do. And I understand why they're doing it. There's these structural impediments to doing what I think is good for individuals. There's all these structural impediments. And I think that we take too many cues from professionals. And the number one, and I could go through a long list of them, the number one thing is equating risk with volatility. For people that may not, I guess, understand those terms and understand how this works, in the investment industry, when they talk about risk, anytime they talk about risk, they talk about volatility. So basically share prices bouncing around. And they have to do that because they don't know any of their investors, right? Somebody managing a super fund has no idea the goals of those members, has no idea the timeline they have. They just have this pot of money. And so they use this common measure, this volatility measure. So whether it's standard deviation or beta or whatever. For investors, that's not risk, right? Risk is defined as something bad happening. So what's something bad happening to me? It's not meeting my goal. And so when people take that volatility lens, they invest too conservatively. And, they're scared of things bouncing around when they're investing super for 30 years. And the prime example of this is Aussie Super, right? Biggest super fund in Australia. 90% of their members are in their balanced portfolio.
Oh, wow.
Yeah.
What?
And it's got something around 25% in defensive assets. And the average age of an Aussie Super member is 42 years old. And so it means a lot of people are younger. And I can't speak for any individual, but I know most of those people are in the wrong portfolio. They should be in high growth. And, we've modeled out, and I won't go through it, we've modeled out sort of what those outcomes can be. And people are not going to hit their goals. There's just no way they will. And I think that's because they're equating risk with volatility when they're not going to touch this money for decades. And who cares how much it zigs and zags? You need that return.
Well, that's a good place to leave it with a reminder to go and check your super and the settings it's on.
Yes.
Exactly.
Well, Mark, there was a reason that you were picked Expert of the Year by the Equity Mates community, because that interview was packed with actionable insight for everyone listening. So thank you so much for coming on. Great to have you back in the studio. Looking forward to the next time and appreciate your time as always.
Yeah, sounds great. Thank you guys very much.
Now, before we go, we want to say a final thank you to Viola Private Wealth for their support of this series and helping us keep all of our content here at Equity Mates free and accessible. Managing wealth in a dynamic economy requires agility and insight. And if you want to see agility and insight, you should see Charlie Viola in a race car.
Very true.
With Viola Private Wealth's expertise, clients are equipped to not only endure market changes, but thrive in any environment. For more information, head to violaprivatewealth.com.au.
Now, stick around because next week we are back with regular programming for the year. And if you've just joined the community for the very first time, Ren and I kick off every year with our bold predictions. We try and look into the crystal ball and put down a few ideas on how we think markets, economies, governments, you name it, are going to play out over the next 12 months. So join us for that. Thank you for tuning in over the summer break. We hope you had a great one. If you're yet to subscribe on either platform, podcast or YouTube, please do so. And if you can leave a rating and review on your podcast app, it really does help us get in front of new audience. Ren, it's been an absolute pleasure. I hope you're feeling rested.
Yes, I'm feeling rested. I'm feeling inspired. I'm ready to make 2025 our most successful yet. So let's get into it.
Let's do it.
You have been listening to an Equity Mates Media production. In the spirit of reconciliation, Equity Mates Media acknowledges the traditional custodians of country throughout Australia and their connections to land, sea and community. We pay our respects to their elders past and present and extend that respect to all Aboriginal and Torres Strait Islander peoples today. This podcast is intended for education and entertainment purposes. Any advice is general advice only and has not taken into account your personal financial circumstances, needs, or objectives. Before acting on general advice, you should consider if it is relevant to your needs and read the relevant product disclosure statement. And if you're unsure, please speak to a financial professional. The hosts of this podcast and their guests may have positions in the companies mentioned. Equity Mates Media operates under an Australian Financial Services Licence 540697.